I'm pleased to introduce our next panelist, Mr. Tom Siemens. Mr. Tom Siemens is Vice President of Commercial Banking for Vancouver Island South Royal Bank of Canada. He's going to be talking tonight about the effects of the credit crisis on commercial lending. Tom joined RBC Royal Bank in 1982 and has enjoyed a career across a broad range of disciplines and consumer bases in a wide variety of locales, including Winnipeg, Calgary, Toronto, Saskatoon, and Victoria. In addition to many volunteer activities, he is a member of the University of Victoria Business Board of Advisors. Over to you, Tom.
I was getting a little worried there. I thought I'd be the only optimist this evening. Did you say I joined in '82, and I think Graham said that was the last serious recession, and then I went to Toronto in risk management lending approval in '92, so I've seen it all there, Graham. So tonight I have to talk about credit markets. You know, it may seem obvious in the bank how credit markets are working, but then I'm always surprised how many questions I get every day about, are you still lending money? And then you watch the news at night, and there's a lot of screaming in the States about the banks aren't lending money even after they got bailout money. And a lot of people don't, I think, understand the problems and how that all works. So I thought we'd have a little Banking 101 tonight, how banks make money and how they structure themselves to lend money. I should tell you that a couple years ago at Christmas, my mother-in-law gave me a little joke gift that said, "Banking, we cheat the other guy and pass the savings on to you." So I think after 30 years, she might need a little remedial training as well. The point we should make is Canada, and I think it's been alluded to already, is not the United States, and particularly in the banking sector. First, we'll talk about the purpose of banks, and I think Graham used the word blood already, circulatory system, and I often use that as a good analogy for what banks do. Financial intermediation is just pure and simple, and it's always been. It doesn't matter how sophisticated you get. It's just standing in between the saver and the borrower and intermediating between the two of them. So we borrow the money and give savings rate, and then we rent the money out to the borrower. So it's really the circulatory system of the economy, and it's the circulatory system of the world economy. So just like if your blood supply got cut off in your arm, the arm would die. And so that's what's happening, particularly in the United States, or has been happening, is the circulation of money has been stopped up. It's almost as if they have cholesterol in their veins. And so that's the whole point of all these thrusts, is to get the money flowing again. How do banks make money? This is the real interesting part. Banking really is just a high-volume, low-margin business. And it really, there again, hasn't changed much. Anyone who was around in the 60s, it was almost legislated. You got 3% on your savings account, and we lent the money out at 6%. And that's a pretty good analogy for how it still works. 3% is the difference that banks work with. And it's actually a little less than that. But so we make money by paying 3%, if you want to use that analogy, and lending it out at 6%. So there's a 3% margin. Out of that 3%, which is our gross revenue stream that flows into the banks, 1.5%, about half of it, goes to pay the staff and keep the lights on. So now we're down to 1.5%. Banks traditionally have a normalized, survivable write-off rate of 0.5%. So out of all your assets, you can basically only write off 0.5% a year and still stay in business over the long term. So if you take 3% minus the 1.5% to pay the staff and the lights, another half off to write off in the normal course of business, you're down to a 1% business. I don't think anyone's going to feel sorry for us at the end of the day here, but so basically what that means is banks have to be right 99% of the time. If you are not right 99% of the time, you're out of business, because you cannot write off more than 0.5% a year on a consistent basis. If you start going to 1%, 1.5%, 2% write-offs, you not only start laying off staff, which we just heard about, then you're out of business over the long term. So banks have to be right, we'll keep this in mind, 99% of the time. After 30 years, my wife would tell me I'm lucky to be right half the time. But when I put the tie on in the morning, I got to change hats and be right 99% of the time. The banks, of course, make money other ways as well, selling services, trading foreign exchange. But primarily, our main role in this life is to keep the money flowing in the economy, from those who have it to those who need it. The other thing I want to talk about banks is capital structure, because we hear about recapitalization of the banks, all these massive write-offs. Basma put on $1 trillion on the screen. It's probably more than that right now. I just want to explain how that works and what the result has been. When you capitalize a bank, your asset, your personal balance sheet is obviously assets, your house, your car, your furnishings. Your liabilities is your mortgage, your car loan, and then you have an equity component, the part that's really yours. And you try and grow that over time by paying down your debts. Your debts are the bank's assets, of course, because you're paying interest on your loan. So the bank's assets are really everyone else's debt obligations. So we have our whole side of our asset side of our balance sheet is debt obligations, loans and mortgages, securities that we hold, maybe some buildings that we own. On the liability side, of course, is the deposits. Canadian banking system is structured so that about 75% of our deposit base is what we would call retail deposits. That would be your mother's savings account, your savings account, GICs, that kind of thing. About 25% is what would be the wholesale market. So that would be the large monies that flow around, literally flow around the planet. So that's not personal money, it's large pools of investment money. So the banks in Canada are structured that way, where a good chunk, 75% at least, of our deposit base is very stable, because people usually a run on the bank really doesn't happen in Canada per se, because people all don't run down en masse and take their money out. But the wholesale money is the money that can flow very quickly, literally overnight, and it can leave the banking institution if the investor is worried. So I should just step back for a second there. Well, first I'll finish off. So we have wholesale deposits, large retail deposits, and then of course our equity base, the capital base of the banks. So the capital base of the banks, under regulations, and this is international regulations, for every dollar in capital that we have, our equity, we can lend out $10. So we lever ourselves. And that's how banks sort of magnify their profitability, because for every dollar of equity, we can give $10 out, knowing that we'll only write off that 0.5% I talked about. So the banks are levered 10 to 1. The Wall Street investment firms that have now literally disappeared were really, and it was mentioned before, levered 30 to 1. So their debt versus their equity was very big. They were funded basically, or always, by wholesale deposits, that what we call hot money, that if that hot money gets worried, it can literally leave overnight. So the problem with the investment firms on Wall Street and why they've disappeared is because literally overnight, if people were worried about them, they yanked out all their money, they became insolvent, and they were out of business. So getting back to our leverage, for every dollar in capital, we give $10 in loans. The $1 trillion on the screen, you have to think of it this way. If there's $1 trillion in capital that has now been wiped out, that means $10 trillion has been sucked out of the lending capability of the planet. And if it's more like 1 or 1.5, 2 trillion, that's like 10 to 20 trillion dollars that's no longer available for loans. So that's what really happened in the last year. We had all these write-offs, and the problem is the banks that had incurred these write-offs, their capital base now is wiped out or very diminished. They have to bring back their lending portfolios back down to manageable or legal limits. And then they are very reluctant to lend anymore, or they're not capable of lending anymore. So just to make the point that the $1 trillion capital is really magnified at least 10 times. So when someone says there's a credit crisis, yes, there's a credit crisis, because that $10 trillion is no longer there. So there's no more loans to make with that money. The other thing I want to make a quick point about capital, so what the banks do, they have $1 in capital, $10 in loans. So for each, we have very sophisticated risk allocation models. So we take a little sliver of that capital and allocate it against a loan. And if the loan's a little riskier, we allocate a little more capital against it. So it's a very structured process where we make sure our exposure based on our capital base can withstand the risk we're taking on. So, I mean, the models that the banks employ, so if you are a less than creditworthy customer, your loan would attract more capital because you're viewed as being a little more risky. Same with the business loan. If a business loan is quite a bit higher risk than the one beside it, we attribute a little more capital to that. And then likewise, the pricing goes up. I just want to go back to the start of this crisis, and we talked about the housing bubble in the States, and we all know that. We all know the subprime crisis. I just want to step back a little further because we're going to have a few questions, I'm sure, about regulation and what banks should be told to do and not do. The root of this problem, in many ways, was back in the 1990s, where the U.S. public policy makers decided under the Community Reinvestment Act basically that owning a single detached home was a right, not a privilege anymore, and started pressuring the financial institution to, for want of a better word, adulter their standard prudent lending practices. In lending, you have the C's of lending, cash flow, collateral, character, that you evaluate before you decide to make a loan. The pressure from the Community Reinvestment Act in the United States, and this is the legislatures and the politicians in the States, basically saying you need to lend to less than creditworthy people, and that's where we really started getting the advent of these ridiculous mortgages where the ninja mortgages, no income, no assets, no job.